Welcome to Protect and Grow with Chicagoland certified financial planner Tim Stearns of TJ Stearns Incorporated. Trust, respect, and results. TJ Stearns Incorporated focuses on comprehensive financial planning and benefits.
And welcome into the program. This is Protect and Grow Chicagoland Retirement with Chicagoland's resource, certified financial planning professional Tim Stearns, CFP, president and founder of TJ Stearns Inc. Tim, always a pleasure to have you on the program. A lot to sort through in the financial world, obviously, and a lot of concerns about our money, especially in retirement. You are here to help provide some perspective and insight on how to have more confidence as we move into or through that retirement phase of our life.
Yes, Peter, and in step with that, today I want to go over the 7 financial myths. We've talked about these in the past, but I think last year bears a reoccurring theme here that we need to talk about the 7 financial myths. And number 1, the market always goes up. Number 2, the 10% average market return. Number 3, a 4% retirement cash flow. Number 4, taxes will be lower in retirement. Number 5, I don't need life insurance once I retire. Number 6, I can rely on my investment plan for retirement. And number 7, it's too late to plan for my retirement because I don't have enough. And, when we do these plans, they are very comprehensive. That's why we say that there's a minimum of $500,000. I'm trained as a certified financial planner professional. So I am always happy to help people. But the plan that I'm speaking of, is good for people that have over $500,000. You have less. We have lots of resources on our website that can help people. Of course, they can still call and we can point them in the right direction. But I would ask that people that want to do a comprehensive look over their plan have at least $500,000.
Well, if that is you, ladies and gentlemen, and you are concerned for your financial future, take the opportunity to get the help and assistance of a team of qualified professionals, specifically Tim Stearns, CFP, a certified financial planning professional, and get your plan together, the written Protect and Grow plan for your retirement. And that offer is for the first 10 callers with at least $500,000 saved for your retirement and your financial future. Pick up the phone and give a call. 800-640-2256. That's 800-640-2256. TJ Stearns Inc. is headquartered conveniently in Arlington Heights with offices in and across the country. And Tim does also hold regular classes throughout the Chicagoland area where you can learn more, maybe get the details on these 7 financial myths, as well as many of the issues that unfortunately plague retirement, make it more challenging, make it more difficult, and then how to specifically plan and prepare to reduce or minimize or even eliminate those unnecessary difficulties. That is what the Protect and Grow plan process and the classes that Tim Stearns makes available are all about. So if you would like to get that plan together or find out about an upcoming event, pick up the phone, give a call, 800-640-2256, or as Tim mentioned, resources available online to help you in your process and progress. That is tjstearns.com, tjstearns.com. And Tim, when we look at this list of these 7 financial myths and get into it, a lot of people's plans and therefore their financial future, the stability of their quality of life, are actually reliant on some of these myths or misconceptions holding true. And that's why we want to discuss each one of these, because we have to question how reliable these beliefs are. And these are pretty commonly held beliefs.
Well, let's launch into it. The first one is the market always goes up. And that may be true over time. But if I'm in my early 60s or getting ready to retire in my middle 60s even, I don't have a lot of runway left to grow my portfolio, because basically I'm a net seller of assets, meaning whatever I have in my 401k is kind of the end of the road, right? The only growth I'm going to have is in the market. So, and if I'm taking money from it, then I can run into a problem that most participants don't know about, and that is sequence of return risk. What that means is that if I retire into a bull market, which if I have a crystal ball, that'd be a great story, wouldn't it? But I don't. But if I retire into a bull market, more than likely my retirement should go as planned, right? And that should be not an issue. But if I retire into a market like last year in 2022, when the average 60-40 portfolio went down at least 16%, then I have a problem there. And because I'm actually going to be taking more money than what I want it to do.
That's 1/6 of a lot of people's life savings, Tim.
Absolutely. And that's an issue. And that's why I think this begs the question, do you have a plan? And if you don't have a plan, you do have one. You're winging it and you're hoping for the best. And I'm going to tell you right now, the market doesn't always go up in your early retirement. It has had years where there's 3 years of losses, and that would really be detrimental to anyone's retirement plan.
Yeah, you mentioned specifically 2022, but I was also thinking of 2000, 2001, 2002, 2007, 2008, 2018, 2022, many years. And in fact, the better part, more than an entire decade, from 2000 through 2012, Tim, the market was essentially flat with a whole bunch of dips and recoveries along the way, but a 12-year period where it really didn't make any progress. And we don't know if the next 10 years is going to look like that or more like the last 10 years, but leaving it up to chance is something that a lot of retirees probably don't want to do, but may be doing de facto if they have not set that protect and grow plan in place. So again, ladies and gentlemen, if you feel like your financial future and lifestyle may be reliant on this financial myth that the market's always going to go up into and throughout your retirement, and you'd like to carefully reconsider that, pick up the phone, give TJ Stearns, certified financial planning professional Tim Stearns, CFP, a call for your Protect and Grow written retirement income plan, 800-640-2256. That's 800-640-2256. Tim, not only the belief that the market always goes up, which we are, again, talking about financial myths, that is not the case. And we just have to look back 1 year to really question that one. But not that it only always goes up, but that it always goes up by some predictable, dependable amount, such as the 10% average market return myth. Why do we have this belief that the market has always gone up or averages 10%? Is that something that holds true, or do we need to carefully reconsider?
Well, when I started in the industry in 1994, so it's 29 years ago, we were able to say that, we were able to say to people that, we average 10% in the market is, that's been the historical average. But the last 22 years of my career, you can't say that anymore. If you remember back when we talked about this through August of last year, before the market, dipped even more, the average return in the S&P 500 was around 5%. So if I'm thinking I'm going to be receiving 10% or even 8%, I'm well above and beyond being optimistic. I'm being unrealistic. And that's what I would tell people, is that 10% is not something that is doable anymore. And the way that the markets go, like you talked about, the valleys and the peaks are too much. And I'm taking money out in retirement, the 10% is going to be hard to come by. The other thing I'll mention is that when I see people that come in after class, after the radio show, listening to us, they'll say, oh, this, my other advisor ran this projection. It's like a 8% return forever. And I want to ask you, have you ever seen a market do 8% every year with no drawbacks? The average drawback is every 7 years. So that's not fathomable. And we have to be realistic in retirement and be more conservative.
Carefully examine that rate of assumed return in your retirement outlook and projections. Is it realistic, ladies and gentlemen? Looking back at the real world returns of the S&P over more than the last 2 decades, it has been far from the 10% that many plans project out into the future. And if you are assuming 10 or 8, but only getting 5 before fees, costs, expenses, or income withdrawals, then you are well off of your expectations. And we need to understand that on the outset of retirement. That's why Tim Stearns, CFP, and the team from TJ Stearns, Inc. do offer to put together that Protect and Grow plan. Carefully examine your plan for all of these 7 myths, as well as the 9 critical risks that every retirement plan must address. We've talked about that one in previous weeks. But ladies and gentlemen, to get that Protect and Grow plan, again, a simple phone call to get the conversation started. You can meet in person or virtually. You can start with just a few questions over the phone. Tim Stearns has the headquarter office of TJ Stearns Inc. conveniently located in Arlington Heights. So you can visit there or, again, virtually for your ease and convenience. Get the conversation started, though. 800-640-2256. That's 800-640-2256. 800-640-2256, or visit tjstearns.com and click on the Connect with Us button. And Tim, under this particular myth of the 10% average market return, you also emphasize that past performance that's advertised by mutual funds may be a bit misleading. And I don't want to get too far in the weeds into math, but you've got a scenario here where there's a 3-year average 10% return, but the investor actually ends up with less money than when they started. And I think a lot of people may be shocked by that if they haven't personally experienced it before, but many have.
Well, and this is actually a slide in our class, in our retirement class, that the average return is actually usually different than the actual return. And I run a slide showing that. So what you're talking about is basically showing somebody that when they give you your average return, it's not a realistic number, just like a 10% number isn't realistic. I would ask people if they want to see an example of it, give us a call. We'll email them this, the 7 myths of the financial markets out to them, to show them that. I mean, it's a little bit much to do it on the radio, but it's definitely a great example of what you're speaking of.
Yeah. Now, ladies and gentlemen, if you have not achieved the returns that you would expect seeing the past performance of the funds that you are in, if you're wondering why that may be, this is definitely some math that you need to see. You need to understand the myth of the average rate of return and how the math actually works. So pick up the phone, give Tim Stearns, CFP, TJ Stearns Inc. a call, 800-640-2256. And certainly you want to understand if your plan and your financial future, your lifestyle and retirement is reliant on this. That's what the written Protect and Grow plan will help you to discern and determine and figure out and make sure that you have a better, more realistic understanding of what expectations for returns are achievable and what they mean for your financial future. Again, pick up the phone, give a call, 800-640-2256, 800-640-2256. In particular, as it relates to myth number 3, which is essentially how much income can we generate from a portfolio? And Tim, I know for the better part of the last 3 decades, more than 30 years here, it was kind of the assumption of the rule of 4% or the 4% rule. How have changes in interest rates really affected this over the course of the last year or two, or maybe the last 10 to 20 years?
Well, you're talking about the 4% retirement cash flow. You know, the 4% rules is what people used to call it. It fails now 67% of the time. So most people don't use it anymore. 4% is too high of a withdrawal rate, they're saying. In fact, the University of Missouri and the University of Arizona study from just a month ago said it should be about 1.9%. So that's more than half less that you should be pulling out to be safe. And I don't understand how people could still think about that out there as the 4% rule. So that does not work. The person who came up with that back in the middle 90s does not use it. And, you know, Wall Street Journal, Morningstar have come out with things saying that it should be 2.3 to 2.6%. So now we have a new study that's fresh off the presses a month and a half ago saying 1.9%. So if you're thinking you're going to be pulling 4% from your portfolio, I would think that again, have a plan and make sure that you're not counting on something that has been disproven, basically.
Tim, I know that for the better part of maybe the last decade plus, a lot of people, despite a low risk tolerance level, we're actually moving assets into greater risk because of the low interest rates. And now we're seeing money kind of shifting back because interest rates have improved. Yep. Does that have any bearing? I mean, I know it's 2 opposite ends of the spectrum, and we don't necessarily have to swing all the way to the other end of the spectrum and back, but do those changes have any impact on the income that we can generate in retirement reliably?
Well, Peter, obviously, if you're taking risk, obviously, if the market trails back like it did last year, like I said, the 60-40 was on average down 16%. Well, then, that you're taking a lot of risk. Now, if you shift the other way, even if you're into some bonds that might be paying 4%, you still are not keeping up with inflation. So that is an issue. And, the whole idea here is to stay ahead of inflation, right? So I would tell you that, undue risk, you could lose money. You flip the other way, you're going to have a problem keeping up with inflation. So you need to have a plan and figure out where you're going to take money from when inflation's crazy. If there is a recession, where are you going to take money from? The markets are down, where are you going to take money from? I'm going to keep saying that. You need to know what your sources are going to be so you're not locking in a loss because you can't pay your bills.
And again, that is what the Protect and Grow plan is specifically aimed to help you address, ladies and gentlemen, so that you can generate that cash flow. You can understand where that income is going to come from in retirement with a higher degree of confidence. Some reliable, durable, dependable income is the baseline for your lifestyle confidence, quality of life into and throughout retirement, and making sure that you are not reliant on any of these commonly held myths or misconceptions in the financial and retirement world. 800-640-2256 to get that Protect and Grow plan put together. 800-640-2256, 800-640-2256, or you can visit online, tjstearns.com, to get the conversation started there. Number 4, Tim, a big one, and one that is actually pretty costly. We are seeing a lot of people really understanding the full impacts of this, but the myth that taxes will be lower in retirement.
Well, it's interesting that you bring this up. So I've asked classes in St. Louis, Florida, Arizona, and obviously Chicagoland for years this question. And I ask, it doesn't matter what party they voted for or didn't vote for. I ask, what are taxes going to do? Everyone to a person has given me a thumbs up. So the myth that I'm going to be in a lower tax bracket goes out the door right there, because we know that the current tax laws are going to retire at the end of 2025. They will expire and they will go back to what they used to be. And like you talked about, if it goes from 12% to 15%, well, that's a fourth increase for me, right? 25% increase, right? So taxes will be lower in retirement? I don't think so. And that's concerning. So, are there opportunities out there? If you've stopped working, you're not making as much money, maybe you look into some Roth conversions. You have this year, 2024 and 2025. But that being said, I think taxes are going to be up in the future. We have this huge hockey stick. We spent a lot of money as a country. Someone's going to need to pay for that. And I would tell you that is a myth that is busted, not going to be lowered income taxes.
Yeah, plan ahead, ladies and gentlemen. Be proactive on this one. This one is maybe your largest known expense in retirement, and it is controllable. And we know what the laws are as they stand today. Into the near future, taxes will be going up. That is already law on the books as things stand. And even the lowest 12% bracket bumping up to 15%. That's not 3% more taxes, as Tim Stearns, CFP, just stated. That is a 25% increase on your tax bill on those dollars that fall in that bracket. So let's control that bill. Let's plan ahead, be proactive. And part of the Protect and Grow plan is protecting from unnecessary taxes as well. And if you've got that concern for your retirement nest egg, that the taxes may be a bill that you would like to control and minimize where possible, who doesn't? Pick up the phone, give a call. And by the way, the more income, the higher net worth that you have, the more costly of an issue this is to ignore because of our progressive tax system. So let's get a handle on that. If you have $500,000 or more saved for retirement, Tim does make the offer for the first 10 callers to the program to put together that written Protect and Grow plan for your retirement. All you need to do to get started, to take advantage, give a call. 800-640-2256. That's 800-640-2256. 800-640-2256. Tim, next myth on the list here. I don't need life insurance once I retire. Why is this a commonly held belief, and why may people want to reconsider?
Well, I run into this quite a bit, whether it's in class or in the office, or people come from the show. Basically, the kids are raised. I don't have a mortgage anymore. I don't need this anymore. Well, I get that. But here's the thing. The largest asset that you have is usually your 401k besides your house, right? So, or IRAs, however you want to put it. And so what's going to happen is when you pass and your wife or spouse, you're going to have to, your children or beneficiaries will have to drain your accounts within 10 years. Okay. That's a lot of taxes. So for pennies on a dollar, you could get some life insurance, right? That would help with the taxes on that. The other thing is at the end of 2025, another tax is sunsetting or going away. And that is the estate tax. It's going to go back down to 5 million. The party in the White House right now has talked about moving that down even lower. So I ask you, if you are not using some of your IRA money because you've had a plan and you've done well in the market, why not get some life insurance for pennies on a dollar like Tom Hegna talks about, our resident expert that we had just a week ago, and put some money in there? The last thing I'll say is that 7 out of 10 Americans are going to need long-term care over the age of 60, and 9 out of 10 of us don't have it. Well, guess what? In the life insurance, most of them have a rider for long-term care of some sort, where you can take, for example, a fourth of your life insurance death benefit for your care. And I've run into people who wish, shoulda, coulda, woulda on that. So I'm talking about helping with estate taxes, a tax-free death benefit that won't ever change like that. You can actually access cash value in it if you need it, and it doesn't go against your Medicare surcharge, the IRMA. And then lastly, I hope you don't need it, but 2 out of your 7 ADLs, activities of daily living that you can't do. Well, guess what? My wife can pull down 25% of my death benefit for my care. And we all know out there in Chicagoland how expensive that is.
I'm going to throw in a final one, Tim, which is simply spending confidence. And I'm 42, but looking ahead to my retirement, myself, my wife, I want to make sure that she is comfortable and confident, and I want to have fun and be able to spend confidently without reservation. I feel like I wouldn't be able to do that without some mechanism in place to help her refill the bucket in case we spend and enjoy life throughout retirement, or there are those healthcare expenses later on in life. And having that refill there through the life insurance component is what will, in my mind, give me the confidence to be able to spend confidently and enjoy retirement. So again, just something to reconsider and certainly to discuss as you are constructing your plan, something that will be discussed and addressed with the Protect and Grow written retirement income plan in the planning process there at TJ Stearns with certified financial planning professional Tim Stearns, CFP. Pick up the phone, give a call, 800-640-2256. That's 800-640-2256. 800-640-2256. Tim, I think we're going to get to number 6 on today's program. I can rely on my investment plan for retirement. And talk to us why we need to reconsider this financial myth.
I'll say one word, 2022. The buy and hold that people have done for 13 years, right? We had a bull market, lost $16 trillion last year, right? So your investment plan, anyone could have been Warren Buffett the last 13 years. Last year is what made men out of people, or, women. Little boys and girls doing 13 years of a bull market is fantastic. But the real winners, were last year that didn't lose as much as the others. Right. So having tactical active money management, you need that. You need stop losses. You cannot rely on an investment plan like a buy and hold for retirement. Why would you drive a car without brakes? Why would you drive a car with your eyes closed? That's the institutional money managers that I've talked to said that. For last year, they said there was nowhere to hide. Well, we did better than the averages. And I'm happy to provide that to people if they want to give us a call. There's no guarantees. I'm not saying that, but we did better than the buy and hold. That is for darn sure. And I would tell anyone, give us a call and we'll put it apples to apples and see how your investment plan turned out for your retirement.
They can do that portfolio comparison for you, an analysis of your current positions, ladies and gentlemen, also an analysis of your risk tolerance compared to your actual risk exposure in your current accounts and positions. A lot of people overexposed to risk based on their need for returns, their expectations of those returns, and the appropriateness of risk, the ability to stomach and make it through losses and downturns in the market. So let's make sure that the portfolio, that the plan is in alignment, and that you've got all of the features on your vehicles, the brakes included, on your financial accounts. Tim Stearns, certified financial planning professional, CFP, can help you with that. Pick up the phone and give a call for that Protect and Grow written retirement income plan. 800-640-2256. That's 800-640-2256. 800-640-2256. Tim, you started off the program talking about the last one, the myth of it's too late or I don't have enough. But if you would just quickly recap the 7 financial myths for us again, and why it is important for people to examine their plan to see if their financial future is relying on these.
All right, I'm happy to do that. So real quick, number 1, the market always goes up. Number 2, 10% average market return. Number 3, a 4% retirement cash flow. Number 4, taxes will be lower in retirement. Number 5, I don't need life insurance when I'm retired. Number 6, I can rely on my investment plan for retirement. Last year should have taught you that that's not a thing. Lastly, it's too late to plan. I don't have enough. I will say this. We had a client who was going to be a referral, and she came in finally. It took her a year, and I said, why didn't you meet with us? And she said, I didn't want you to tell me I didn't have enough. Well, get in here and let's go over things, because we were able to help her. We can help people. Give us a call. Come on in. We can do it virtually, whatever. But let's, push it forward here that we can make you help with your retirement.
Well, again, if you would like that assistance, if you would like the written Protect and Grow retirement income plan, pick up the phone and give a call to TJ Stearns, Inc. and certified financial planning professional Tim Stearns, CFP, 800-640-2256. That's 800-640-2256. 800-640-2256. Tim, we appreciate the time. Always a pleasure. Thank you for being here as a resource for proactive Chicagoland area savers and investors.
Thanks, Peter.
Tune into Chicagoland certified financial planner Tim Stearns' full radio program and visit tjstearns.com for many valuable resources, including other great episodes of Chicagoland Retirement. Be sure to subscribe.
Securities offered through TJ Stearns, a registered representative of Crown Capital Securities LP, member FINRA SIPC. The information presented on this program is provided for informational purposes only, without warranty of accuracy, completeness, or suitability for particular purpose. This program is not intended to be and does not constitute financial, investment, legal, or tax advice. This information is general in nature, not specific enough to be construed as advice. You should not make any decision based on the information presented on this program without independent consultation with an appropriately licensed professional or competent advisor. Investment in securities or the market involves a potential risk for loss of principal. Trading, therefore, may not be suitable for all listeners. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs.